In this video, we're going to discuss hedging in practice, or at least delta hedging in practice. So we can think about the example of perfect hedging. So the Black-Scholes-Merton framework assumes the stock is log normally distributed, and that if we have an option position, we are going to delta hedge continuously, buying and selling fractions of shares all the time, and we're going to maintain a zero delta portfolio. So if we buy or sell options at the fair value, so if we buy them, we pay the fair value. If we sell them, we receive the fair value, and we continuously maintain our zero delta portfolio, then under all circumstances, we will neither make nor lose money. Now, this has some implications. Let's say, for example, we're long a call option. We've borrowed money to buy it. We're long call option. We've borrowed money to buy it at the fair value. If we hedge perfectly in the framework, there are two possible outcomes. First, the option could end up in the money. We're long the call option. If it's in the money, we're going to exercise it. In this case, just before we're going to exercise the option, we're going to be short one share, and we're going to have the strike in our bank account, meaning we have the dollar value of the strike in our bank account. We exercise the option. We pay the strike, receive the share, and close out our short. If we're long the call option and the option ends up out of the money, in this case, just prior to the expiry of the option, we have nothing, no shares, nothing in our bank account. The Black-Scholes-Merton framework guarantees that we will have the right position. This is also true if we're short a call option. If we're short a call option and pay the fair value to sell it, then if we hedge perfectly, there are two possible outcomes. If the option ends up in the money, then just prior to someone else exercising the option, we're long one share and we've borrowed the strike, that many dollars, in our bank account. The counterparty exercises the option. We receive the strike because the counterparty is buying the share, so we receive the strike, pays off our borrowing, we give them the shares, we have nothing left. If the option ends up out of the money, in that case, just prior to expiry of the option, we have no shares, nothing in our bank account. In either case, we end up with exactly the right amount of money in the right position for either exercising the option, having the option exercised, or in the case the option ends up out of the money, doing nothing. Now, if we're in an imperfect world, so we're not hedging perfectly, then this doesn't quite work. So if we can't hedge according to the Black-Scholes-Merton framework, which is certainly true, we might not be able to hedge continuously. We might not be able to buy fractions of shares, that sort of thing. Then we accept that this isn't going to quite work as well as we would like. So for example, a trader might hedge once or twice a day, depending on the asset and depending on how much the market moves. As we saw before, if we did nothing, we have a P&L distribution that looks like the picture on the left. Again, remember, so the picture on the left is 45% of the time, in this particular case, we lose our investment, and then there's some probability of making money. That probability is so small on the histogram on the left that when we need to take out that 45% spike in order to see it. The expected return of this distribution is zero. Now, if we delta hedge even once a day on a one-year option, we can turn that distribution into this distribution. So this is the distribution of the P&L. This is a histogram. The distribution of the P&L, assuming the stock is log normally distributed with the expected return equal to the risk-free rate, and we delta hedge once a day. And this is a much better behaved distribution, right? We have reasonably high confidence that we are going to make between plus and minus $1. Now imagine we're a dealer. Our job is to buy or sell the option and make a spread. Let's say we made, this option was worth $10.45 up front. Let's say we made a 20-cent spread. That would shift this P&L distribution to the right. If we traded reasonably regularly, making that 20 cents or 30 cents or 10 cents or whatever it happened to be, reasonably regularly, what would happen is this P&L distribution would shift to the right. It would shift to the right far enough so that we'd have a profitable business. there would always be the probability, a possibility, that the fact that we hadn't hedged perfectly means we could lose money on this trade, right? There's always a chance, even if the P&L distribution, the expected value is 0, that the actual outcome is not. So we accept some P&L noise, and our profitability, the spreads we charge, should cover those profits and losses.